Well, good day, traders. My name's Chris Weston. I'm head of research at Pepperstone. I'm looking at the week ahead. I'm going to do it slightly differently this week. We're going to focus very much on volatility and what it means and the elastic band being pulled back. There's so much pessimism in these markets right now. I don't think anyone really needs me to tell them that. But instead of going through the finite points of what to look for and the stumbling blocks, the event risks for our portfolio, I don't think we need to address that, where we're looking at, what's going on in China in terms of the high frequency data dump, the retail sales, industrial production numbers, or what's going on with the UK jobs report, or, employment here in Australia. I think we need to take a global macro view because correlations are picked up so substantially in markets, and we've got to address the heart of the issue. I mean, there are three things, I think, that obviously the case count that's happening in the virus, obviously that's spreading across the world, and we're going to continue to watch the intensity of that, the exponential growth. I don't know if there's much that we can do about that. I mean, that still needs to play out. The second thing, of course, is what's Trump going to do. We saw Trump make a key announcement yesterday at the Oval Office. He's obviously disappointed the market, talking about paying workers for sick leave and some loans for small businesses. But it was basically bringing a spud gun to a gunfight. It really underwhelmed, as did the ECB meeting. They needed to see something more, and I think the market's saying to themselves, we've got a scenario in our head, we need to see that scenario play out, or we're going to throw a bit of a tantrum, we're going to push you closer to that point. If you look at markets now and look at where we are, the pessimism in the market as we go into the next week is extreme. And I think, you've got to take a view on what the Fed are going to do as well. The market goes into this coming week's Fed meeting pricing 3 to 4 rate cuts, basically taking the Fed funds rate down to the zero lower bounds. The question is for me, why would they wait? 3 or 4 days in this market is an eternity. They might as well go and do an emergency meeting, cut rates down to zero, get it over and done with. Why wait in that situation? It's inevitable it's going to happen, in my opinion. The market doesn't really care about rates. That's not going to solve the issue. I was quite infused by what I saw from the Federal Reserve coming out and increasing their repo operations, $1.5 trillion over the coming 3 days. They've changed their US T-bill purchases towards more sort of longer duration assets into terms of treasuries across the curve. That is stealth quantitative easing, but I don't think quantitative easing through the use of treasuries is going to solve this issue. In fact, you could say in some ways counteractive what's going on. Now, I know they're using treasuries as collateral for cash, so it's slightly different from generic quantitative easing or large-scale asset purchases, which is what we want to see this coming week in a different form. But you don't want to be taking quality assets out of the system. There's a scarcity as it is. Taking US Treasuries out of the market, I think, would actually disincentivize people to push themselves out the risk curve. So therefore, I think the market is looking at this Fed meeting this coming week and asking to themselves, what is the possibility of the Fed exploring the idea of changing their mandate to be able to buy corporate bonds and also potentially equities? Now, the legal system is quite grey. I'm no legal expert, but if you have a look at what is it actually indoctrinated into the legislation, which was designed in the 70s, it said that you can go and buy bonds, you can buy mortgage-backed securities, you can go and buy gold, you can buy dollars out of the system. But it doesn't actually say you can't buy corporate debt, and it doesn't say you can't buy equities. It just doesn't have it under that banner. So therefore, the system is quite grey. And the fact is, we've got Jerome Powell, who's an ex-lawyer at the helm of the Federal Reserve. It could be quite easy for them to actually go out, if the situation required, like we've seen in Europe and the Bank of Japan, to go out and buy corporate debt. And that's one of the issues now. This systematic situation, and I think basically OPEC and Saudis coming out with a price war has really brought the credit markets into this vein. If you have a look at corporate credit spreads, this is what equities markets are keying off at the moment. If you look at high yield specifically, we've traded from on the credit default swap, the cost to protect you against a default against the corporate event, credit event. That's gone from 293 basis points back in February up to where we are at the moment, just in the high 600s. That's a massive move, and equity markets have feasted on that as credit spreads have widened. You've seen equity markets coming under pressure. So for the Fed to come out and give us some indication further down the line that they are really studying the idea of corporate debt, I think would be a very powerful signal. So will they give that signal? There's a good chance that they will, in my opinion. In the short term, there's a pretty good chance they'll come out and say that they're going to go and buy mortgage-backed securities from the market. I think if they're going to get an outright QE, large-scale asset purchase program, it's probably going to be more on the mortgage-backed security side rather than US Treasuries, which they're doing their repo operations, as I say. But we want to understand, is there going to be any indication that they're studying the idea for corporate debt and also equities? That would be a game changer in my opinion. But if you have a look at the way these markets are positioned, have a look at the VIX, 75%. You know, we're basically trading up to the levels of implied volatility in the S&P that we haven't seen since the GFC, where it got up to 89%. We can have a look and break that down into S&P calls and puts and have a look at 25 delta implied volatility there. And you can see that the implied volatility for puts, the right for downside, is trading at 80%. Now in the GFC we got to 82%, so we're pretty much at all-time highs implied volatility for 1 month S&P 25 delta puts. If you have a look at calls, well you'd say that they're still very expensive, though those implied volatilities for calls are trading around sort of just over 50%. That tells me that the market's saying, yeah, we probably expect we're hedged and we're positioned for further downside. But if we are going to see a rally, that rally's not going to be 1 or 2%. That rally is going to be closer towards 8 to 10%. Call volatility is also quite expensive. Now, if you have a look at this chart of the difference between the two, you can see in the top pane where I've basically looked at 1 month 25 delta S&P calls, and I've minus the implied volatility of puts. You can see that's sitting at negative 27%. It's never been this low. You know, is that a contrarian indicator as well? Is that an indication of pessimism? I think it is. If you have a look at the lower pane and look at the level of absolute level of CBOE puts to calls, you can see that sits at 1.52. That's over 3 standard deviations of this long-term move. Again, this is what I put into my pessimism model to understand just exactly what's priced in as well. You can have a look at short-term VIX, the cash VIX effectively, and look at that as a ratio of the 3-month VIX, a slightly longer term. That sits at 1.3 times. Again, that is at levels which is quite extreme. We can have a look at implied volatility in the FX market, and you can look at the JP Morgan implied volatility, and that's really come alive. We'll talk about them in a second. 13%. It's the highest level since 2011. Bond volatility has been incredible. And one of the great interesting things now is that real yields, 5-year real yields, if you look at inflation adjusted, that got down to negative 84 basis points. There's been a rapid move higher over the last 3 or 4 days. That now sits at positive 4. Now, if you're using the bond market as a hedge against your positions that you may have in the Russell or what you've got in the S&P, you know, you've just seen that natural hedge coming unwound. And the fact is that real yields have moved up quite aggressively. If anyone who's out there is trading gold wants to know why we're seeing gold move to the downside, well, perhaps there is an argument that people have sold gold to raise cash to pay for these losing positions in equity markets. But the fact is that real yields, inflation-adjusted treasuries, have moved up so aggressively. And I think that's part of the reason why the equity market has come under pressure. It's because you know, real yields have moved up so sharply, and that's something that we need to keep an eye on. People have been talking about what's been happening in the equity market. You can't deny that a 27% move in the S&P in 16 days is unparalleled. We've not seen the ferocity of that selling, and you've got to blame the Fed for that. In my opinion, they incentivise pension funds to sell calls, get that yield enhancement, and effectively what we've been seeing is market makers really coming out and selling gamma and selling US Treasury, S&P futures. That's exasperated the move down. You've seen people looking to the CTAs, the trend following crowd, seeing the market trending lower. It's obviously, we've seen bear markets popping up everywhere. They've been sort of adding to that as well as they look to go short in US Treasuries and Russell futures and in S&P futures and Russell futures and whatnot there as well. So that's obviously exaggerated the falls as well. So we've seen some rapid moves down. If you have a look at the Bloomberg Financial Conditions Index, you know, you can see just how this all works. When you aggregate everything together, whether it's money markets, it's TED spreads, you know, it's credit spreads, it's implied volatility in the S&P and all these various factors that go into the real world and this feedback loop into real world economics, you can see that sitting at negative 4.3. Again, the Fed would have seen this and they said, look, we can't just let this happen. We have to impose. Now, of course, we've seen them go through those liquidity operations. That was punchy. That was crisis management 101 right there from the Fed, but they need to do more. It goes back to my point. If they're going to cut rates, why wait till next week? Get it over and done with. Get ahead of the curve. Show them they're meaning business. Get the rates down to zero. Hold another emergency meeting and really come out at the Fed meeting next week and tell everyone that you're going to be buying mortgage-backed securities as part of a proper QE program, and also come out with an identification that you're going to be looking to buy credit spread, corporate credit down in the future, and try and suppress some of the volatility in the credit markets. If the equity market's going to be rallying, it's going to be because credit spreads are narrowing once again. If credit spreads continue to blow out, you're going to see funding channels dry up. They're going to be liquidity issues, and that's going to exasperate the problem. So this Bloomberg Financial Conditions Index tells me that the Fed need to do something, and that's fast. So the market wants to see two things. The first one is that the Fed give a signal that we're going to see QE4 under corporate bond buying, maybe some equities. They want to see mortgage-backed security purchases as well. They want to see that monetary base coming through. Liquidity is not going to solve the virus, but it will certainly help financial crisis conditions here. We also want to see Trump and the administration coming out something that really properly addresses the demand destruction that's going to coming through. Not this limp situation, this lightweight solution that was provided here, but something that's powerful, something that addresses the potential for a real economic hit that's going to take place. Now have a look at FX markets throughout the week. For so long, FX volatility was missing. You saw big volatility in the oil market. Of course, that's part of the problem at the moment. You've got big volatility in equity markets. That continues to be the case. But look at the volatility in FX markets over the last 5 days. It's all been yen buys. It was last week. It continues to be this week. Dollar yen's down only 0.5% or so. But if you have a look at the Noki, 9.6%. That's an absolute staggering move. All-time lows in the Nokia against the dollar and against the yen. The Mexican peso, all-time lows against the dollar, down 9% against the yen there. The rand, down 5.9. Aussie yen, down 5.8%. Yeah, these are punchy moves by any standard. You can see these markets go up. They look like a bit of a blip on the screen, but when you actually measure it in percentage term, it's 1%. These are the kind of markets you need a wider stop. You take your position size right down in that situation. Now let's have a look at that FX volatility I talked about. Yeah, we've got the Bank of Japan meeting this coming week. Are they going to cut rates? I wouldn't be surprised if they went down something similar to what the ECB did, and that is leaving rates on hold. We thought that they were probably going to cut rates, but they've obviously left them there to incentivize profitability in the banks. They've come out with more liquidity measures. I think that's probably what we'll see from the Bank of Japan as well as they go into their meeting through the week, and that's we're going to see more liquidity. But it's about the Federal Reserve and it's about Trump. Those two together are what we looked at really closely, and of course the virus count as well, and how aggressive this is going to be, the exponential case count, and what it means for things like closing cities. What are the going to measures there that's going to impact on economics? And I think that's the thing you've got to look at as well. Will there be more volatility? It's not just the Fed, it's not just Trump, but there's going to be actions, school closures around the world. We're going to see potential cities being closed. That's going to have huge economic consequences as well. But will the market actually rejoice and say, fine, it's going to have an economic hit, but it actually gets us to a point we're going to much sooner to see an end. Now have a look at the implied volatility in the FX market. Aussie yen, 36%. Absolute crazy stuff at the moment. 296 pips up or down. The market's saying that Aussie yen's likely to trade in 62.91, 68.83 range. Dollar yen, you've got a 29% 1 week implied volatility. You can see that in the middle pane. 79 percentile. It's come down a little bit. It was a little bit higher than that. I think we got up to 36% on dollar yen. But still, if you're trading dollar yen, and you're using 4-hour charts up to daily charts, and you're not scalping markets, and this probably doesn't matter as much, but the market's expecting a 359 point move up or down. Aussie dollar, you can see there, actually it's 100 percentile. I haven't updated the 52-week high because we're trading there at the moment. That's 24%, gives you a 296 point move in Aussie dollar up or down. That's 59.90 down to up to 65.82. So the wings are getting wider. You can see that the implied volatility is really pushing out. You can see that coming down. Euro dollar, which obviously started to be faded a little bit there. That's trading at 14% implied vol, but that's 111. So you can see where this is coming. Dollar yen, absolutely staggering stuff. You're expecting fireworks in really any of the yen crosses. People love to use that as a safe haven there. Have a look at risk reversals. Again, you're looking at that skew, that difference between 1 week 25 delta call volatility minus put volatility. Have a look at Aussie dollar, negative 3.3. So basically put volatility trades at a premium against call volatility for 1 week at 3 vols. That is the 100 percentile. We've never been this, well, we haven't been this low for a long time. You go to dollar yen, 8 vol difference there. So obviously put volatility very, very expensive relative to calls. Tells you that the market says themselves, if we're going to see anything, the path of least resistance is down. Gold's an interesting one. You know, it's come off, as we can see against this chart, against what's happening against real yields. But you can see that calls are still holding a 2.8 vol premium to that of puts. That's come down from where we were. We actually got this week up to 5.96. So people were very bullish, but that's come back a little bit in line with that repricing we've seen in real yields. But it's dollar yen that fascinates me. 8 vols, you know, that's as, you know, getting as punchy as we've ever seen. And that tells me that everyone's speculating on downside there as well. So what are we looking for this week? You know, if you look at pessimism, you know, it's very difficult to see that we've traded at these kind of levels before. Corporate bond spreads have ramped up. That's allowed equity prices to move down aggressively. No one's been buying. There's been a lot of artificial selling that's played through. Implied volatility is as high as we've ever seen it. But that elastic band's going through. Now, the question for me is, I think we are going to see a rally. Inevitably, it's going to happen. The question is it going to happen tonight? I'm saying this on Friday. Are we going to see it on Monday? Are we going to see it on Tuesday? It's going to happen. The problem is timing in trading is everything. The difference in when you've got implied volatility this high is that if you get it wrong by a day or 2 days, it can be very, very costly indeed. But we are going to see a punchy rally. There's no doubt in my mind that the positive level of pessimism comes in and the catalysts are there. The question is when it's going to happen. We could be down another 5-10% quite easily before we see the market getting what it wants to see. But good luck to everyone out there, and obviously keep your position sizing accordingly out there.